Let me know, guys, how has your week been so far? Have you been trading the volatility? Have you been making money from it, or you've been losing money from it? Because the real fact is that in a volatile market, you can make money, massive one, and you can as well lose money, massive one. So it works both ways, you know. And in tonight's session, what we are going to be looking at is how to actually make money from a volatile cryptocurrency market. If you've been in the crypto space for the past 2-3 months, or let's just say 6 months, then you know what volatility means. Volatility is why many people are currently trading the cryptocurrency market, because people know that cryptocurrency market moves than other kind of markets or financial markets. Even in a bull run or in a bear run, cryptocurrency will always do a large move, a large percentage move, either up or down. So this is part of the reason why so many people are in cryptocurrency, and that is even the main reason why you see a lot of people saying, oh, this coin did 2 times, this coin did 200% for me, it did 300%, it did 400%. Ordinarily now, I'm talking about ordinarily, not even on futures trading, you understand? So that is what volatility is basically on Crypto-Based Media. My name is Rock, and I'm going to be your tutor for tonight. Yeah, so Crypto-Based Media holds this kind of webinar every Saturday in a way of giving back to the cryptocurrency community. We share value here for free every night on Saturday, just a way of saying thank you to our audience, giving you all free content and making sure that you all are staying profitable in the crypto market. Yeah, and tonight is another one. Like I said earlier, our topic tonight is how to make money from a volatile cryptocurrency market. So I'm going to be sharing my screen with you guys now so that you're going to see everything I'm doing and you can follow through. How to make money from volatile markets. Option, share screen. Great. I hope you all can see my screen right now. Yeah, here we are. Yeah, so what is volatility? That's the first thing we are going to be looking at. What is volatility? Well, volatility is a measure of how much the price of an asset has moved up or down over time. It's so simple. Let me come again. Volatility is a measure, when you want to measure something, of how much the price of an asset of a particular coin, maybe Bitcoin, Ethereum, FTT, BNB, USDT. Oh, sorry, you can't measure USDT because USDT is supposed to be a stable coin. But volatility is basically how these coins move up or down, like the speed that they use to move up or down. Normally financial markets moves, the stock market moves, the forex market moves, everything moves up or down. Now, volatility is actually the speed and the kind of percentage that this particular market or this particular coin is moving. That is basically what volatility is. Very, very simple to understand. Now, volatility is when you see a coin at $1 in the morning and later on in the afternoon you see the coin at $2. That's 100% move, right? That is volatility. Now, look at the other side. Volatility is also when you see a coin at $1 in the morning. Now you see the coin at $0.5. That is a minus 50% move, right? That is volatility. So this is part of the reason why you see why many exchanges or let's say many crypto articles you read, they will first warn you that cryptocurrency is an highly risky asset class, that it is highly volatile, and that you must know what you're doing before you trade cryptocurrencies, because actually if you don't know what you're doing and then you're just there, you're trading crypto, you're definitely going to lose that money. Well, you might get lucky with a few trades, make some few money, but I promise you that money that you said you made, the market will collect it back from you. Why? Because you are not really knowledgeable about the market. So part of what you should learn about cryptocurrency is volatility. Volatility is one of those things that are important in the cryptocurrency market. Now, we have directions of volatility in cryptocurrency, which is basically up or down. You can have a volatility to the upside, or you can have the volatility to the downside. Now, don't forget that in this class, we want to know how to actually make money from these fast movements, from these 20%, 30%, 40%, these large movements. That is what we want to know how to do, either up or down. That's what we are going to be looking at tonight. So we can have volatility to the upside, and we can have volatility to the downside. Volatility to the upside means the coin is pumping like crazy. A coin is pumping like crazy, like a coin did big percentage in just one day. Do you understand it now? That is what volatility to the upside means. And then I'm going to show you some of the example. I'm going to show you guys some of this example. Let's see if we can go back to the bullish markets. Let's see the bullish. Yeah. Look at this, guys. This is a volatile market. This is presently a one-day chart, and if you look at even this particular candle, is giving off a 27.54% movement just in one day. Just in one day, if you put $100 Friday 20th, let's say you put $100 in this particular coin on Thursday 19th of August 2021, and then you wake up the next morning, you see the coin pumping, and then the coin pulls a 27% move from your $100. That means you already have about $127 in total. You already made $27 profit from that movement. So that is what volatility is. But that is volatility to the upside. Now take a look at volatility to the downside. This one is very, very easy to see these days, because definitely we are in a bearish market. So we are going to see something like that very easy. Look at this, is just a 9% movement in one red candle. Still looking for something very, very large. Okay, here we have it. Okay, let's see. Okay, this is an 11% movement. So this kind of volatility, let's say if the money is in this particular pair at that time, and the money comes down, the market moves down 11%. That means you are going to lose 11% of that fund. If it is $100, you lose 11% of that $100. That means you are going to be losing around $11 or something. And even if it is $1,000, you definitely lose 11% of that $1,000. But now if you are a futures trader, it is very, very easy for you to gain 11% profit, or even more than that, because the market moved down. And that is if you took your position, your short position, early enough before the market went down. So now that we've taken a look at the volatility to the upside, we already know the kinds of volatility that we can have in the cryptocurrency market. Now it is time to know it is time to know why the crypto is so volatile. The cryptocurrency market is an asset class that is very, very volatile. It can be compared to other asset class, although there are other asset classes that are also volatile. But cryptocurrency, you can search it anywhere. Cryptocurrency is one of the asset class that is the most volatile out there. That is very, very volatile out there. In fact, even if it is not the most volatile right now. So why is it that crypto is now so volatile? Now, part of the reasons why cryptocurrency is so volatile is because cryptocurrency is still a new asset class. Although cryptocurrency has been around for a while, in the 20s, 2012, 2009, 2010, 2013, and all of that. You're going to see coin histories from 2012, 2013, and all of that. Fine. We know that is around more than a decade ago, more than 10 years ago, right? But do we still now call that new? Yes, it is still new compared to the stock market, compared to the forex market, and all of the other markets that have been around since. People have been trading these markets since 18th century. So that is just it, honestly. So cryptocurrency is so volatile because it is still a new market, and institutions are still looking at this market. This market is still very young. Last I checked, cryptocurrency is still dancing around $800 billion in market cap. The market cap is called market capitalization, which means the total value of a particular market. We can have the market cap of the stock market. The stock market also, if we calculate all of the asset class, all of the assets in the stock market, calculate everything together, you're going to be seeing trillions of valuation, in the stock market. That is it. Now, cryptocurrency also has I think during the last bull run, cryptocurrency is around $3 trillion market cap. I think $3.3 trillion, the total value. But now that 3.3 trillion has already come down to around $800 billion. That is more than half of it shed off because we are in a bearish market. So now I hope you understand why the cryptocurrency market is so volatile. Like a lot of people will just advise you just stay away from cryptocurrencies. Why? Because it is volatile. Why? Because it is volatile. Now, that is going to lead me to the next point, which is why you should embrace volatility. A lot of you will be thinking, okay, Rob, this thing you're telling us that is dangerous. Why do you expect me to embrace something that is dangerous again? Well. We know that it is risky. We know that it is volatile, but still, this is what makes cryptocurrencies different. This is what makes cryptocurrencies interesting. This is why people are into crypto. Why? Because of the volatility. And because of the volatility, it is that volatility, if you embrace it and you know how to use it very well, that is what is going to make you big money. I hope you all are getting this now. It is that volatility that will make you big money in the cryptocurrency market. So, cryptocurrencies are volatile, but if you position yourself properly, then you can enjoy and profit from this volatility. If you are not on the other side of the volatility, if you are not on the negative side of the volatility, then fine, you can profit and make your money from volatility. This volatility that will make your coin pump. Coins are doing 200, 300% in a day. It's very, very possible in cryptocurrency. So that is what volatility means, and that is why you should embrace volatility, because of course you can't see, if you are going to be looking at the stock market and all of that, you can be seeing 2%, 3%, 5% move in a day and all of that. But if the market is in a bullish market, crypto market most especially, you're going to see something like 10, 15, 20%. Imagine you putting your money in a coin yesterday and you woke up this morning, you are seeing a 20% gain. Wow, that's interesting. I just showed you guys an example. Over there. Even if you come this way, if you come this way, July 2022, these are 30% movements. Putting your money in here, 26th of July 2022, and then waking up, let's even say you woke up the next couple of days, 28th, which is Thursday, you already have more than 10% movement. You already have 13% movement on that particular money. That is what cryptocurrency is. If you head over to other asset class, you are just going to see 2%, 3%, all of that, all those small movements. But cryptocurrency is known for that big movement, and that is because the market is still very young. So if big money enters the market, this is just the secret. The market is still very young, and if big money should enter the market, big money can easily influence the price of the coin. But because you see those big asset class, those stock markets, because the market cap is already so big and it is already less volatile. So if big money enters, well, they might really just a little bit anyway. Only if bigger money enters that kind of market, then that is when you are going to feel it very well. You understand? But in cryptocurrency, if you have somebody with billions of dollars, the person can easily move the market. Even millions of dollars can move some particular coins. Millions of dollars can move some particular coins that have low market cap also, don't worry if you are still new to all of these terms that you are hearing me say. Just keep on with crypto based media. You're going to definitely be understanding all of it later. So now that is that on why you should embrace volatility, because volatility is what makes you money. Volatility is what makes crypto. Yeah, I know some of you might have this question in your head, although I'm going to take questions later, but some of you might actually have this question in your head that, okay, what happens when the volatility of crypto dies out and all of that? If the volatility dies, or for volatility to die out, that means a lot of people have embraced Bitcoin, a lot of countries, a lot of institutions, is already normal, is already legal tender almost everywhere, such that Bitcoin itself will be one of the less volatile assets. Why? Because the market cap would have already been much, the market cap would have been more than what it is today. Do you understand? So market cap would have been more than 1 trillion, more than 2 trillion, 3, 5, God knows. So that is it. That is what can really make cryptocurrency to be less volatile. And when it becomes less volatile, that means you might not really see those big profit anymore. But you can still see big profits if you trade the futures markets, where you have the opportunity to use your leverage. So that is it. Yeah, let's move on to the question right now, which is how to trade and make money in this kind of market condition. I know this is what a lot of people have been waiting for. You really want to know how you can make money from a volatile cryptocurrency market. Yeah, so we are going to be dividing this into two. Yeah, one for spot traders, one for futures traders, and we are going to be taking a look at it one by one. So we all should just stay focused at this particular point. Yeah, so the first step, I've planned everything out in a step for you. So the first step is marking out levels. Yeah, let me tell you guys one secret about this market of a thing. You see, when the market is dumping or a market is pumping, what traders, what analysts take a look at is the next valid levels, the next zones. And what I mean by this is that let's say for instance the market is dumping right now, and let me just go to my trading view to show you guys a real life example. Oh, what's up with this trading view? Yeah, so let me just show you guys a real life example. Let's show you guys a real life example. Yeah, so basically, if you see a market that is dumping, what people want to know is that what level is next. Yeah, let's take a look at this point. Take a look at this point right here. You can see that this market dumped, this market crossed this particular level, horizontal line. Yeah, you can see that these markets actually broke this particular level, which served as the previous support. So now, if something like this happens and the market is dumping, what you want to look at next is to know where next this market is going to. And how do you know that? It is simply by checking back on what the market has done before, and seeing where exactly is the important levels. If you look at this point to the left, just take a look at it to the left right here. Okay, let me make it my replay to right here so that you guys can see it very well. Yeah, we have it here. Yeah, so let's just say this market is currently dumping and this market is about to break that particular line. So as a trader, what do you want to be looking at? You want to be looking at the next important levels, right? Which is around this point, which is around $30,000 or let's say $29,000. Now, that is where it is expected that the market is going to get to next before the market now continues any other activity that is going. So this is you simply marking out levels. So now let's quickly just mark out that particular level. Yeah, let's just quickly mark out that particular level, and then we're going to play the bar now and see how exactly the market reacted at this particular level. Yes, you could see that the market dumped even past that level, but then the market later started to consolidate at that particular level. Now that you've seen that, once you've marked out your level, the next thing you want to be doing is setting your alert. Setting your alert, it is very, very important that you set your alert so that you get notified when the price crosses that particular level that you are interested in buying. As a spot trader, you only get the opportunity to buy first before you then sell. You don't just short in the spot market. So now, once you've marked out your level, the next thing you want to be doing is to know exactly where you're going to buy that particular coin at. Although it is very, very hard to determine when it comes to a bearish market. That is why sometimes you just need to have patience with this thing. But once you've marked out your level, then you could as well take your buy there. But you should know the kind of market condition you are trading first. In a bearish market, it's not always advisable that you just keep on buying. No. What happens mostly in a bearish market is that there are a lot of sells and a lot of buys. Only if you want to have a relief pump and you want to target a particular relief pump, then fine, you can as well make your buys in a bearish market. And then you should know that it is only short term. Like for instance here, let's say our level is right here, and then taking a buy at this particular point where this point was consolidated later to at this particular point. And when it gets to the upper resistance, which is here, smaller resistance here, we just have a mini support and mini resistance right here. And when it gets to that point, we take our profits and we move on. That is how to do it in a bearish market. But when it now comes to bullish market, once you see that the market is trying to correct, or the market is trying to do a correction, and you want to take your buy, it is just as simple as first setting your alert. And then now, one thing that can really also help you from losing money if you're a spot trader and you want to like time volatility and you want to trade volatility is that you should actually divide your capital before you buy anything. Yeah, dividing your capital means you entering bit by bit, not entering the market at once. It's very, very important that you know how to divide it. Okay, let's say for instance, you want to enter a particular position with $200, but you don't want to enter that particular position with $200 at once. No, you want to divide it just in case the market comes down again. So another level, you mark out another level that you think is reasonable. Then you enter at the first point, enter at the second point. If there's a third point, you enter at the third point. Even you could even divide your assets into 4 places, and then you continue entering like that. And when the market comes back, you have your profits. It's as easy as that. And if you are not dividing your what is it called, your capital, another thing you could do is to take your buy positions with stop loss. Yes, you just need to take a look at the demand zones and you take your buy right there. Yeah, you take your buy right there. So that is it. That is it on trading volatility in the spot market. Now, I want you guys to note that it is highly risky. That is why you need to use a tight stop loss. Even if you are trading in the spot market, you still need to use a tight stop loss. This is very, very important. Now, let's take a look at how to now trade a volatile market. How to trade a volatile market. Yeah. If you are a futures trader, if you are a futures trader, how to trade the volatile market as a futures trader. Yeah, we are still going to make use of, let's see if we could make use of another coin. Let's make use of Chiliz. Choose. That's CHZ. Yeah, so trading volatility in the futures market, just like the previous one, you need to first mark out your levels. It's very, very important. Marking out your levels, you could even start with your 1 week time frame and see what's up. Starting out with your 1 week time frame and see what's up, see where the market is actually going to. Just draw out those simple levels. I'm not interested in a triangle. Thank you. Yeah. So if we just easily set out these levels, map everything out, know where the market is going to, know where the market is coming from, know if the market dumps, where is it going to? If this market is pumping, where is it going to pump to? Yeah. See this quick one we just did right here. So now, once you've set out your levels, you've marked every levels, the next thing you want to do is to set your alerts. That's the next thing you want to do. So those prices that are very, very interesting to you, you could easily set your alerts. Like right now, I'm looking at this coin, which is CHZ. The price point that is interesting to me as a trader right here is around this 0.097. Yeah, but that's on a weekly time frame. That's on a weekly time frame, so that might not really come like that. So let's just take a look at the 1 day time frame and see what's up. This is the look at the 1 day time frame. Yeah. So right here, if I want to be looking at levels that is interesting to me, I want to be looking at somewhere around here. Yes, somewhere around here. If it's a rectangle tool, I can really draw out my levels and make everything really perfect. So I want to be looking at somewhere around there, and then I want to be taking my action from there. Like for instance, you could easily see that this price point, this is a former resistance, and anybody that is, when the market was dumping, everybody that wanted to take any action will be looking at this particular former resistance, that it might be a key level for this particular coin when it is dumping. And look at this, the coin was dumping and the dumping stopped at this point, exactly at this point, which is the key level. Do you see that now? So even as a futures trader, you could easily take your longs here. Why? Because you've already seen a previous resistance right here. You've seen that resistance right there, and then you could take your longs there and you are going to make your profits and you leave the market. Now, let's even say this market is even pumping up. Okay, fine. We could see this strong level up above here, and if the market comes up, we want to shut it down again. So guys, this is how to really trade this volatile market. One thing I want you guys to know is that it's very, very possible in volatile markets that quick take out. If you're out, don't be angry, don't be annoyed. Trade what you see. Just trade what, like my boss script pastor always says. He say, you don't have to bother about where the market is going, what are you afraid of, what's the market is. Just trade what you see. Trade what you've analyzed. That thing exactly that you've seen, that you've analyzed, If you have friends, if you have trading buddies, you can share it to them, ask them what they think about this your particular trading idea. Set your alerts. Setting your alerts is also very, very important. Once you set the level, set the alert. And also, it's important that you use low leverage and you use low capital. That is also very, very important because the market is uncertain. You know, there are people that have bigger funds than you that are trading and manipulating this market currently at that particular point. So if you go ahead to go and use a big capital, or maybe you went ahead to go and use high leverage, and unfortunately you didn't set your stop loss and you got bonds, that's your own fault. You know, you already know it's a volatile market. It is risky. It's something you already know before. But as a cryptocurrency trader, you don't just look at it. You have to take calculated risk. That is how the money is being made. You need to know how to calculate your risk. You know, using your calculator, Binance has access. You can have access to your futures calculator in your Binance app. It's very, very easy to use over there also. So it's just something that is very, very easy to do. So just need to know what you're doing. You need to use your low leverage, you need to use low capital. You know, it is a volatile market. Nothing is certain right here. And then you trade the longs and shorts depending on the volatility direction. Now look at this. The volatility that happened last week, the direction was down. The direction was downward. Do you understand? So if I'm a trader, I want to be trading the other way. Do you understand? Because I expect that the market might possibly pump from here, or even if the market did not pump from here, if it breaks this particular line, then that means where are we going next? We are going down next. So I don't want to short that breakdown. But I'm not really a fan of shorting breakdowns anyway. You know, I still prefer to see that breakdown retest before I now take a shot in it. So that's it, guys. And also, yeah, you know, we've talked about when we were talking about the trading volatility in sports markets, we said making use of your tight stop loss. Now, in futures markets, you need to make use of very tight stop loss. You need to make use of very tight stop loss. Why? Because futures trading is even more riskier than it. So now, if you are trading futures and you are now trading a volatile market all at the same time, know that you are going all in for risk. So that is why you should also learn how to protect your capital and set your very, very tight stop loss. Not just tight stop loss this time around, but a very, very tight stop loss. Now, if your trade has triggered, let's say for instance, you set your particular buy position right here, and then your trade triggers and it is already going in your way, the best thing to do is to show your profits because the market is still being manipulated. The market is still highly volatile. So you don't even know what is going to happen next. Man, if I change this particular chart to a 4 hours chart, you guys are going to see all of the manipulation going on. You guys are going to see all of the look at this week. You know, I said it. I already knew it. Look at this week now. You know, very, very confusing. Look at the way they took the market. It hits both level, both support and resistance. Look at it. Just take a look at it. See that manipulation right there. That is what we are talking about. You know, that is why you also need to set your stop loss very, very tight. Very, very tight. And even if the market takes out your stop loss and that goes your way, just don't worry. You don't need to stress yourself on that. Just leave it alone. The trade was not meant to be. Do you understand? Because if you are thinking, oh, I don't want the market to hit my stop loss and all of that, if you do not set your stop loss, it will even be worse because it is actually good to keep your losses minimal and make sure that your profits are much than your losses. So that is it. That is it, honestly. That's it. You can see this market right now. This market still looks a little bit bullish. Looks like it wants to go ahead to touch that particular resistance right there. So once you start moving your stop loss in profit, the next thing for you to do is to enjoy your profit. So that, guys, that is how to really trade a volatile market. You know, the most important thing right here is just that you heed to the warnings of the stop loss, the low leverage, low capital, because I notice that a lot of people get greedy when it comes to a volatile market. Normally, we have times that the markets are very, very boring. When the market is boring is when the market is moving just sideways. The market is just moving sideways and it's not that interesting. But a volatile market, man, very, very interesting market. I'm not going to lie to you. The last week, okay, sorry, it's still this week. Today is not Sunday, today is Saturday. It's still this week. So I actually did trade. It was still that same choose that I traded. I traded choose. I think I entered around 0.177 something. I can't remember the entry point. And then I noticed that, okay, fine, the market was already going my way. I was trading my profits. Now I noticed that it did around 70%. And then I moved my stop loss to around, let's say, 45%. Now, the market, I just opened my app again and I saw that, man, my stop loss has already hit in profits. Do you understand? So I already made like 40% of whatever capital that I put in. So that is actually how to trade this particular market. It is as easy as that, guys. Now, if you really want to know more about trading, volatility, and trading the market as a whole, then you need a cryptocurrency course. I'm not going to lie to you. You need to learn these things. You need to, if you want to be in a particular signal group, up to one. I think last time we had around 90% win rates. People in that particular signal group can bear me witness that we had around was it 80 or 90? I can't remember, but I remember that it was only one trade that didn't go as planned. It was only one trade that hit stop loss, and that is why we even set stop loss. Man, me, if I stop loss, I'm always happy. I'm always happy because I knew that I could have lost more than that, if not for the stop loss. So to me, stop loss is my angel. Stop loss is just my beautiful angel. So you really need to learn about cryptocurrency, knowing how to trade and all of that, taking signals, being in a community where you have a group of traders where they trade longs and shorts, share screenshots of trading, sharing trading ideas, sharing trading signals, even amongst traders right there. Then you need to take our cryptocurrency course on CryptoBiz Media. So if you're really interested in taking any course, if you're really interested in taking the course, kindly message Crypto Pastor after this particular session. That CryptoBiz Media, just send a message, send a direct message to that CryptoBiz TV Media number. So like always, I always love attending to questions after every session. So this session is not going to be different. So if you have any questions, just kindly raise your hand. I'm going to give you the mic. You are going to unmute and you are going to ask your question. So guys, shoot. Let me hear if you have any question. Oh, is there no one without question? Oh, maybe everybody understands everything that we've talked about tonight. Looks like everyone understands. I'm not seeing any hands up. Where is my guy? My guy is always asking questions. He's not here. Miro. Where is Miro tonight? Okay, Miro is not here. Okay. So I think there's no question. Okay, Sahid. Okay, Sahid, I'm going to give you the mic now so you can speak and ask your question. Yeah, Sahid, you could unmute yourself and speak right now. Let's hear you out.
Good evening, boss. Hello, good evening.
Yeah, come again, Sahid.
Hello, good evening, boss. Good evening.
Yeah, good evening.
Yeah. Sir, please, I just want to ask a question about how to calculate the risk in the volatility period like this. How to calculate the risk.
Okay.
How to calculate it. How do we calculate it?
Okay.
So I want to know how to calculate it, sir.
Okay, no problem. I'm just answering a question right now. Okay, thank you very much, Said, for that question. Yeah, Said asked that wants to know how to calculate risk. Before you enter any trade, you must know how to calculate your risk. You must know where to set your stop loss exactly. And a lot of people make mistakes when setting stop loss and all of that. Let's say, for instance, the market is currently about to be volatile. Let's say this market wants to be volatile. And as a trader, I want to set my trade here. Yeah, as a trader, I want to set trades. I would like to short that particular market. I like to short that particular market. So I would like to put my entry around this blue line. Great. I would like to put my entry around that blue line, and maybe my TP1 should be here, my TP2 should be here, and then let's see if this thing is actually going to give me. Okay, great. Now, for me to set my risk properly, I want to be setting my risk a little bit above these lines right here, a little bit above those lines right there, and you could see it, 2.41%. That is where my risk is. Now, if I want to calculate this particular trade, if I want to calculate the risk, how much exactly I'm going to be losing for this particular coin, I'm not going to be opening my balance app for you guys. Don't worry. But I'm going to show you guys how to do it. Now, what you should do is to just open your Binance app. If you hear me right now, you want to know how to do that, just open your Binance app right now. Go to that futures area in the bottom, then click on futures. Once you click on futures, you see like you want to take a trade where you see longs and shorts. Then in that upper area, you see something like a plus, a division, and a minus sign. If you just click on it, you head directly to the futures calculator. So once you get there, you have to see the leverage. You input the amount of leverage that you want to be using there. And if you're not using leverage, just leave it at 1 time. If you're using 5 times leverage, make the slider, turn it to 5 times, 10 times. And now, once the leverage is set, now what you want to do next is put in the entry price. In the entry price, we said we want to be entering the market at this particular point, which is 0.2905, the gray area, 0.2905. You input it there. Now, your stop loss too, you input there 0.2975. Now, you now put that amount, that particular amount, you are going to put the total amount that you are going to use to enter that trade, calculated with the leverage. Let's say you are entering the trade with $100 on a 5 times leverage, that's $500, right? That's the amount you are going to put in there. So once you put in the entry, you put in the exit, you put in that $500, you click on calculate. Once you click on calculate, you see the amount that you are going to be losing exactly there. It is very, very clean to you. You see it in percentage and you see it in dollar amounts. Do you understand? So now, once you've done that, the next thing you want to be doing is you want to see the amount you're going to be gaining if the trade actually goes your way, which is actually, let's even say our target is around this point, 0.22, let's just say 0.23. Now, you input that exit price, you delete it, put in 0.23. So once you put in 0.23, you click on calculate again, you see how much you are going to be making. As easy as that. That's how to use the calculator. And I can remember that I even did a video on how to make use of Binance calculator on our crypto-based media platform, where I made a real-life example with the Binance calculator. So you could as well go to crypto-based media YouTube channel. Just go to YouTube and search for crypto-based media and just search this way, crypto-based media Binance calculator. You just search it that way. You are definitely going to see that particular video where I did a simple guide for you guys there. So honestly, that is it. Okay, I see more people wanting to ask questions again. Okay, Margaret, I'm going to be giving you the mic right now so you can speak and ask a question. Okay, you could unmute yourself and speak right now. So
good evening, our
yeah,
lecturer, and good
good
evening,
evening.
house. Yeah, the question I want to ask is about stop loss. I saw your video where you explained the difference between isolated and cross. In isolated, you said the particular amount you put there is what you are risking if you don't set your stop loss. But
Yes.
in cross, if you are trading and it's going on not in your favor, it will go to your account and take some money, you know.
Yes.
So the
Yes.
question
Very
I want
correct.
to ask now is it compulsory to set stop loss in cross? Since that the something will go to your account and take money there, so that you will not be liquidated. Is it still necessary to set stop loss?
Hmm. All right. Thank you very much for your question. Thank you very much for your question. So I'm going to be answering that right away now. Yeah. The question is, isolated and cross. That is it. Important to set stop loss when using cross margin, right? Now, one fact is that either you are using isolated or you are using cross. There is one very, very important thing that every trader should know, and that is capital preservation. That is capital preservation. Now, why should you allow your trade should be in a loss up to the extent that the trade goes and the particular money that you put in that position finishes is now entering into your account balance? That is a very, very bad decision. The fact is that if you set a stop loss, let's say you enter the trade with $100 and you set your stop loss at $10 max, $10. Before the trade gets to $100, the losses, if the losses is at $10, the position will automatically close. You save how much? You save $90. You'll be able to come back another day. But now imagine that you didn't set your stop loss and you are using cross margin. You have a total of $1,000 in your account. Now you're using $100 to trade. Now that $100 gets exhausted. Why? Because the trade is in a loss. and that trade now continues to run into a loss inside your own account, and it is already taken out of that $1,000. The $100 is already exhausted now. Now it's already taken out of that $1,000. You're already using more money. You're already losing more money, and now you are now asking that. The fact is even that if you have set your stop loss from one set, the trade will not even touch your account at all. So either you're using isolated or cross. If you have your stop loss set rightly, then you don't have any problem. You don't have any problem, honestly. People get liquidation letters because of not setting stop loss. I think that's just the easiest definition to it. People get liquidation letters because of not setting stop loss. And as a trader, I don't think you should be getting liquidation letters at all. In fact, me myself, I can count how many times I've gotten a liquidation letter, and it's never more than once or twice. And that is even as a mistake. So as a result of maybe a trade that was set, and I don't even remember that I set that particular trade till that trade entered a loss, and the trade got liquidated after entering the loss. So that is it, honestly. And I'm always on isolated. Even that I'm always setting my stop loss. Even though I'm only setting my stop loss, I'm still on isolated. Such that, let's just say, God forbid something happens, my stop loss did not hit. If the trade is going into a loss, it is only that money that I used to trade that will be affected. Every other thing in my account balance will not be affected. But don't get this wrong. If you are saying something in your account balance getting affected, it is only in your futures account balance. There's nothing that will touch other wallets. It is only whatever is left in your futures account balance, or whatever profits you've made from other trades that you've entered at the same time with that particular one. So honestly, that is it. It's been an amazing class tonight. So thank you all for joining in. Don't worry, if you came late, this particular session is recorded and it will be uploaded on our YouTube channel later on. So thank you all for attending.